Good evening, friends, and thank you for joining us in this session. So today we are going to discuss five very important judgments which have come out in the year 2024 and which will have wide-ranging implications for the industry going forward. So without wasting further time, let's move on to the first judgment which we will discuss today, which is the case of Mineral Area Development Authority versus Steel Authority of India. So this is a very interesting case as well as a very technical case. And the issue over here involved the interpretation of certain entries in the Constitution of India relating to the power of the state or the center to levy taxes on certain activities. A brief history of this litigation is as such. There was a judgment in the case of India Cements in the year 1990. And in that judgment, the Supreme Court seven-judge bench had held that royalty is a tax, and therefore the state legislatures lack the competence to levy taxes on certain royalties which arise out of mineral rights. Because mineral rights was a subject matter of a central legislation, which is Mines and Minerals Development Regulation Act, 1957, in short, MMDR Act. So in a sense, India Cements seven-judge bench said that the states cannot levy any tax on royalty which is charged for any kind of mining activities. Later on in 2004, a five-judge bench in the case of Kesoram Industries held that the India Cement judgment was erroneous and royalty is not in the nature of a tax, but it is a fee. And therefore, the state legislature has the power under the Constitution to levy tax on royalty arising out of any kind of mineral rights. Now, since Kesoram was a five-judge bench and India Cement was a seven-judge bench, Kesoram could not overrule India Cements. So, in fact, what happened was that the issue was therefore referred to a nine-judge bench in the case of Mineral Area Development Corporation, which is this case. Now, the nine-judge bench was tasked with determining whether royalty is in the nature of tax, and that was the substantive issue before the Supreme Court of India. On one hand, the Parliament had the power to legislate on the subject matter, and in exercise of this power, it had enacted the MMDR Act, which provided for charging of royalty on the holder of mining lease in respect of any mineral removed from the lease area. On the other hand, the states also had power to legislate on the subject matter under taxes on land and building, as well as taxes on mineral rights, subject to any limitations imposed by the Parliament by law relating to mineral development. So there was a confusion as to whether the center or the state will have power to levy taxes on any kind of royalty which is arising out of mining activities. So taxes on land and building, as you may be aware, falls within the entry 49 of list 2 of the Constitution. What is list 2 of the Constitution? That is the state list, which means that only the states have the power to levy taxes on land and building. As you may be aware, the state levies a stamp duty on sale of land and building, and therefore the center's power to levy any tax on land and building is excluded. And that's why even under the GST regime, you would have seen that there is no GST on sale of land or sale of a completed building, because that falls within the ambit of the state legislative powers. Now, because the seven-judge bench of India Cement was contrasted by the five-judge bench of Kesoram, which held that royalty was not a tax, therefore, this was referred to a nine-judge bench in the case of Mineral Area Development Authority. Now, what was the finding of this nine-judge bench? The judgment by majority declared that royalty on mining is not in the nature of a tax, and it overruled the seven-judge bench judgment in the case of India Cement. The Supreme Court concluded that land and building in taxation-related entry number 49 of list 2 of the seven schedules includes mineral land. So land and building means all kind of land and building, including land where mineral is mined, whether any kind of mining takes place. And therefore, if there is any royalty, that is not a consideration, and that is a consideration and not a tax on that mining activity. So the Supreme Court held that the state is entitled to tax royalty by virtue of Entry 49, which empowers the states to levy taxes on land and building, as well as by virtue of Entry 50, which empowers the state to levy taxes on any mineral rights subject to limitations imposed by the Parliament. So in effect, the Supreme Court upheld the state's power to impose taxes on any royalty which is charged for mining activities. Now, amongst the 9-judge bench, there was one judge, Justice B.V. Nagaratna, who had a dissenting opinion. What is a dissenting opinion? It is basically when you do not agree with the majority and you sort of disagree on certain points. So Justice Nagaratna actually disagreed with the remaining 8 judges and held that the nature of royalty under the MMDR Act is that it is in the nature of a tax under Article 366(28) of the Constitution, which defines tax to include the imposition of any tax or impost, whether local, general, or special, and the word tax should be construed accordingly. Therefore, Justice Nagaratna held that royalty is not a consideration or a fee, but actually in the nature of a tax, and it is not a contractual payment, but a statutory levy under the MMDR Act. Entry 49 on the list 2 deals with taxation of land and building, and therefore it does not cover mineral bearing lands. That is what Justice Nagaratna said, because tax on land and building under Entry 49 contemplates a tax levied directly on land. So if any tax is levied directly on land, that is subject to the state's power. But if it's an indirect levy on land, then the states have the center has power to levy tax on it. Now, for instance, let's say lease rentals of a commercial property. Now, that is also something which is arising out of a land. But because it is not a direct levy on the land, therefore, the center has the power to levy GST on lease rentals from commercial activities. So the key takeaway from this judgment is that the court held that royalty is a consideration for grant of a privilege for removing or consuming the mineral which is paid in terms of contractual as well as statutory obligation. So it is like a service fee which is being paid for removing the minerals from the land under the MMDR Act. The lesser charges the royalty, the lesser in most cases will be the government, because the government leases this land to the authorities or to the private parties for mining activity, and therefore they charge a royalty. So that is a consideration for parting the right to win the minerals, while a tax is an imposition of a sovereign. So this is the distinction which they made, that royalty is a service fee or a consideration for parting away with a right which the government has in favor of a third party, whereas tax is an impost or imposition of a sovereign, which means that it is an imposition by the central government or a state government, irrespective of whether this is a consideration or not. So royalty is paid as a consideration of doing a particular action, while tax is levied with respect to a taxable event which is determined by law. So royalty generally flows from the lease deed as compared to tax, which is imposed by authority of law. The competence of the state to levy tax or cess on royalty has therefore been upheld. The states are entitled to levy tax on royalty under the law enacted by the state, and there is no direct connection between the taxing powers of the state in relation to mineral rights and regulatory powers of the government or the parliament in relation to mines and minerals. So they said that while the states can levy a tax on the royalty, it does not stop the union or the center from legislating or creating any act or statute in relation to mines and minerals. So these are two different things, and there is no sort of direct connection between the two. The Supreme Court also held that the word land includes land of every description, whether it is agricultural land or a commercial land or a residential land or a mineral bearing land. and also contemplates land as a unit irrespective of the use to which it is put. So this allows the state to levy tax on mineral bearing lands. And if land includes everything below and above the surface, then constitutionally speaking, even the subsoil minerals form part of the land, which essentially encapsulates the difference between states' power to impose taxes on land and building vis-a-vis taxes on mineral rights. So the Supreme Court said that land would also include everything below the land as well as everything above the land, and it need not be something which is in direct connection with the land. So it can also arise a benefit which is arising out of the land is also something which is under the ambit of the state legislature. That is in essence what the Supreme Court had held. Now, as far as the impact on industry for this, there is a possibility of various states now imposing taxes on mineral rights at different rates, which may have a bearing on the comparative competitiveness of various mines and mineral-based industries. So, most of the mines and mineral-based industries are located towards the east of the country, whereas there are some also towards Rajasthan, Goa, etc. So now states will have the right to levy a tax on the royalty which is generated on the uh, mining activity. It might also lead to some unhealthy competition amongst the mining companies, which could result in a slump in the mining activity. This is a larger sort of economic impact which this judgment might have. However, this judgment will be a leading case to guide the taxability of the transactions related to land and building under GST as well. For example, as you know that there is right now litigation, ongoing pending litigation regarding long-term leases, whether GST is applicable on that, transfer of development rights, where the power of center to levy taxes on such transactions have been questioned, and these issues are pending before the court. So this judgment will also sort of be a precedent in determining whether GST can be levied on certain activities which involves land and building. So if leasehold rights are considered as a benefit conferred upon a person to enjoy the occupancy and possession over a piece of land for the lease period, then it may so be that an assignment of a long-term leasehold right may amount to a transfer of benefit arising out of land and therefore outside the purview of GST and outside the purview of center's power to levy any tax on it. So question about applicability of lease of immutable property is also pending before a larger bench of the Supreme Court, which also will now be decided by the Supreme Court, and this judgment will come into play over there as well. So this will be the impact on the industry. Now, apart from this, there was a very interesting issue which we call in the legal term as prospective overruling. Now, what is prospective overruling? It is whether the judgment of the Supreme Court, when a judgment like this comes about, whether that will have a prospective effect or a retrospective effect, and whether the India Cement judgment is overruled retrospectively, that is since 1990 when that judgment had come, or whether the judgment is overruled prospectively. So that issue also arose in this case because this had a very huge implication. Um, so what the Supreme Court says is that the doctrine of prospective overruling is applied when a constitutional court overrules a well-established precedent by declaring a new rule but limits its application to future situation, which is what we were discussing, that prospective overruling is only when something is overruled prospectively and applies prospectively. So demands for tax under the state legislation pertaining to entry 49 and 50 of list 2 of the 7th schedule was stayed in terms of the law laid down in this India Cement case. And since this case, Mineral Authority case, overruled the established India Cement judgment, question of prospective overruling came up. What did the Supreme Court say over here? Supreme Court rejected the concept of prospective overruling and said that this ruling, in the case of mineral area development, will be applicable retrospectively, which means that the states can raise demands for the period prior to this ruling. However, in the interest of justice, the Supreme Court said that there will be no interest or penalty applicable and only tax can be asked for by the states. The Supreme Court also said that if states were to levy any demand of tax, it should only operate on transactions which were made prior to 1st April 2005. And why 2005? Because the Kesoram industry judgment came thereafter. And the Supreme Court also allowed installment payments over a period of 12 years for any demand which was from 1st April 2006 onwards, and levy of interest and penalty was not imposed prior to 25th of July 2024. So, in effect, the judgment has upheld the legislative competence of states under entries 49 and 50 of List 2. This will be not given a prospective application, it will be retrospectively applied. However, in the interest of justice, no interest or penalty for any demand prior to the period of this judgment will be levied by the state government. So this is actually a very important observation, and this will also impact any pending litigations where based on certain judgments of Supreme Court, a position is taken and thereafter that position is overruled. So what will be the impact in those cases? This judgment spells out that impact of prospective or retrospective overruling. And there's a very important observation in this judgment which says that uh, pendency of litigation should not be to the detriment of an assessee. So if there is a litigation which is pending, the assessee should not be put into any kind of hardship because the court overrules an established principle after certain years, and because of which there is a demand which is created retrospectively. So for that purpose, the court said that no interest or penalty. Demand, yes, can be raised retrospectively, but there should not be any interest or penalty, and also gave the facility to make the payment in installments over a period of 12 years. Moving on to the next case, and in a much sort of hyped case, is Commissioner of Customs versus Canon India Private Limited. So we all know that there was a Canon India judgment in the year 2021, which effectively sort of put an embargo on the power of the DRI to issue any show cause notice or adjudicate any cases in the past period. So the Canon India in 2021 said that DRI does not have power for adjudication, and this power for adjudication only rests with the proper officer who did an assessment of duties under Section 17 of the Customs Act. Now, this created a lot of issues for pending litigations. Many of the cases, which were pending before the court, um, and where the assessees had challenged the show cause notices were issued by the DRI. The assessees had challenged that show cause notice, saying that the DRI does not have power to issue the notice, etc. So in 2021, the Supreme Court said, yes, the DRI does not have power to issue show cause notices. However, the government filed a review petition before the Supreme Court. A review petition is a petition which can be filed where there is any error apparent on record in a judgment, and to correct that error, a review can be filed. Now, error should not be something which is difficult to find. An error should be such that it is absolutely apparent on the face of record, and by merely looking at something, you can figure out that there is an error, and based on that error, the judgment which has been passed previously is erroneous. So the government filed a review petition in the Supreme Court to review this 2021 judgment in the case of Canon. And said that there are certain glaring errors because the Supreme Court missed out on a certain circulars and notifications which were probably not presented to the court at the time of Canon hearing initially in 2021, because of which the court arrived at a wrong conclusion. So just to give you a background as to what had happened before that, the first case in this is Sayyid Ali case in 2011. The Supreme Court examined the jurisdiction of Collector of Customs Preventive to issue show cause notices under Section 28 of the Customs Act. At that point of time, the Supreme Court analyzed Section 2, subsection 34, 17, and 28 of the Customs Act. 17 is your power for assessments of assessments of bill of entry. 28 is issuance of show cause notices, and 2 subsection 34 relates to who a proper officer is, or who or definition of a proper officer. The court in that case held that there is a direct linkage between Section 17 and 28, and only those customs officers who are explicitly assigned the duty of assessment and reassessment under Section 17 in a specific jurisdiction could lawfully issue a show cause notice under Section 28. So basically, it said, the Supreme Court in Sayyid Ali said that whoever has done your assessment under Section 17 or provisional assessment under Section 28 is the only officer who can actually issue a show cause notice under Section 28. Now, when they say the only officer, it doesn't mean that the same particular person should do it, but it's the post. So if your assessment has been done, let's say at Navasheva Customs Port by an assistant commissioner under Section 17, then only the same as the assistant commissioner of Navasheva Import can issue a show cause notice under 28, and DRI does not have power to issue the notice under 28. So this is basically what Sayyid Ali said. The Supreme Court said in the case of Sayyid Ali. Thereafter, there were certain amendments which were made under the Customs Act because of this case. And because of the gaps which were highlighted in Sayyid Ali's case, the Parliament enacted the Customs Amendment and Validation Act 2011 and introduced Section 28, subsection 11 in the Customs Act. And basically, the section retroactively validated the authority of all officers appointed under Section 4 of the Customs Act as officers of customs before 06 to 07 2011. That is the case when the Supreme Court had that is the date when the Supreme Court basically said that this is the date from which the assessment and self-assessment period starts. So proper officers definition was changed, and all officers under customs were then the definition was amended to include all officers of the Customs Act as proper officers. Thereafter, there are two judgments which happened. One was Sunil Gupta, Bombay High Court. The other was Mangali Impex, Delhi High Court. In Sunil Gupta, the Bombay High Court upheld the constitutional validity of 28 subsection 11 of the Customs Act to retrospectively amend the customs regulations and include all officers, proper officers. However, in Mangali Impex, the Delhi High Court said that no, 28 subsection 11 was also unconstitutional as it was very broad and it enabled multiple officers to claim jurisdiction. So therefore, the same was declared as unconstitutional. So Delhi High Court says no, that 28 subsection 11, which gives powers to all officers as proper officers, is unconstitutional because these are unbridled powers. But Bombay High Court said that no, that is constitutional and therefore it is valid. And that's the reason why this matter went up to the Supreme Court in Canon India case to decide whether they are proper officers or not. And in 2021, Canon India Supreme Court said that they are not proper officers. After that, the review petition was filed, and there were certain amendments in the Finance Act in 2022 to validate the past actions. So department had filed a review petition. The Finance Act 2022 was also made, had also made certain amendments to validate past actions and address the defects pointed out in Canon India. The amendments were made to inter alia to Section 2, subsection 34 and Section 5 of the Customs Act to empower the board to assign functions to officers, and Section 3 was substituted to include officers of DRI, and a new Section 110AA was inserted, providing that after investigation, the case should be transferred to the officer who had taken the original decision in the matter. So this all was done retrospectively and in the Finance Act 2022 to cure the issues which arise, to cure the defects which the Supreme Court had pointed out in the 2021 Canon judgment. So what happened in the review petition? The key findings are that the court firstly held that there is no interlinkage between Section 17 and 28. There are two different sections. 17 relates to assessments, 28 relates to recovery of duty. So it is not necessary that an officer who does an assessment under Section 17 is the same officer who has to issue a notice under Section 28. So it can be done by two separate officers. They also interpreted the term the proper officer in Section 28, and the court held that the proper officer does not imply exclusivity to authority involved in the initial assessment. Instead, it refers to the officer appointed under the Customs Act to fulfill Section 28's specific function of issuing SCN for recovery of duty. So in the earlier judgment in 2021, Supreme Court said that because the wording into Section 28 is the proper officer, it cannot be any proper officer or a proper officer. It has to be the proper officer who had done the assessment under Section 17. However, in the review, the Supreme Court said, no, that was wrong. The proper officer does not mean that the same officer under Section 17. It means the proper officer appointed under Section 28 can do the can issue the show cause notice to the assessee. The court also analyzed the scheme of officers of customs appointed under Section 2, subsection 34, 3, 4, 5, and 6 in detail, and held that DRI officers are already a part of the customs structure as officers of customs, and therefore they derive their authority from Section 2, subsection 34 and 5 directly. So you don't really need any other circular or notification to give them that power. That power is flowing from the Customs Act itself. The Supreme Court also upheld the constitutional validity of Section 28, subsection 11, which was introduced by the Finance Act 2022. Sorry, which was introduced in the Customs Amendment Validation Act of 2011, effective from 16 September 2011, and to validate the past actions of the DRI in light of Sayyid Ali. Accordingly, the decision of Bombay High Court was affirmed, and the decision of Delhi High Court was overruled by the Supreme Court. Now, what impact does this have on the industry? Firstly, there are many pending cases which will now be adjudicated on merits, and issues such as limitation, etc., before the relevant forums, such as the adjudicating authority, SESTAT, etc. Till now, most of the cases were kept pending by the tribunals, which were where the show cause notice was issued by the DRI, because the matter was pending before the Supreme Court. Now that the matter has been decided, all these issues will be decided on merits without getting into the question of jurisdiction of the DRI to issue the notice. Now, what happens to those cases which were sort of quashed on the basis of the 2021 judgment, where the Supreme Court said DRI does not have the power? There were certain cases which were quashed by the Supreme Court as well as various high courts and tribunals, saying that since there is no stay on that judgment, so that judgment is 2021 judgment is valid. And on that basis, a lot of tribunals, high courts had quashed show cause notices, saying that the DRI does not have jurisdiction. So there, the department, may file an appeal against those and revive those cases. So that is something which needs to be analyzed in each case as to whether department can revive and file an appeal in those cases which have been already quashed. One important aspect in this case is the decision will also raise questions about the impact of the Supreme Court ruling in the ITC case. And if most of you will recall, Supreme Court in the ITC case in 2019 had in fact held that self-assessment is also an assessment under Section 17. And in case anybody has to challenge a self-assessment, a show cause notice, if anybody has to challenge a self-assessment, that person will have to file an appeal against that assessment order. And bill of entry being an assessment order would also need to be appealed if you need to challenge that. And this applies to both the assessee as well as the department. This was a case of refund where the assessee had filed a refund, and without without challenging the bill of entry, which is by means of filing an appeal against the bill of entry, the assessor directly filed a refund claim. So the court had said that yes, that refund claim cannot be allowed because the assessee did not file an appeal against the bill of entry to challenge the assessment, and that's why the refund claim, directly filing a refund claim, is not the proper way to sort of get the refund sanctioned. So you have to first challenge the assessment by way of filing an appeal, and this goes for the department as well as the assessee. And only thereafter, once the order of bill of entry is modified, then you can file a refund claim. That is what the Supreme Court had said. However, there's a significant departure in the Canon judgment, because in the Canon judgment, the Supreme Court has held that the role of a proper officer under 17 is limited to reassessment in certain specified situation, and same must be distinguished from self-assessment done by the assessee. So then Canon, they are actually saying that the self-assessment is not, so to speak, an assessment. It's only a reassessment which becomes an assessment. So if there's a self-assessment, that is not something which should or can be challenged in appeal. So that the Canon judgment can be interpreted in a way where it is departing from what the Supreme Court had earlier said in ITC, where it said that yes, a bill of entry filing is a self-assessment, is an appealable order. So that is interesting to see how that is going to sort of pan out in the coming years, and how the Supreme Court will try and harmonize both the ITC as well as the Canon judgment. Now, moving on to the next issue, which is in the case of Bharti Airtel Limited versus Commissioner of Central Excise. Now, this was a very, very long drawn litigation involving telecommunication towers, whether these telecommunication towers were inputs, capital goods, whether the credit would be allowed, not allowed, etc. This is sort of relevant for a service tax regime, and there were a lot of sort of contrary decisions of high courts on this issue. So the Bombay High Court had in Bharti Airtel's case and Delhi High Court in Vodafone case had a chance to look at this issue, whether mobile towers and prefabricated building will be covered within a definition of capital goods and inputs as defined under the Senvec rules. So the Delhi High Court held that these towers are fastened to the civil foundation to make it wobble free and stable. So this is not something which is embedded. It is only sort of fastened to the structure so that it functions properly and it is stable. It can be unbolted and it can be reassembled without any damage, and also can be relocated to a new site, and therefore are not permanently annexed to the earth. So the Delhi High Court in effect said that these telecom towers are not immovable properties. Those are in the nature of inputs and should be considered within the ambit of Rule 2, Sub-Rule K of the Senvec credit rules. The Bombay High Court, on the other hand, held that these are immovable properties and therefore they are not capital goods or inputs under the Senvec credit rules. They said that towers and parts in CKD would fall under Chapter 7308 of the Central Excise Tariff, which is not specified in Rule 2A or the Senvec credit rules to be treated as capital goods. They also said that Bombay High Court also said that towers and prefabricated buildings are neither components, spares, and accessories of goods falling under any of the chapter of the or the headings of the Central Excise Tariff Schedule as specified in Rule 2A. Therefore, the good in question would also not be capital goods, and therefore there would be no Senvec credit available for towers, for telecom towers. This is essentially what the Bombay High Court said. So because there was a conflicting decision in Bharti Airtel and by the Bombay High Court and Vodafone by the Delhi High Court, this issue traveled before to the Supreme Court, and the Supreme Court came out with a verdict. In effect, Supreme Court said that the principles to determine the nature of property, and held that on the basis of the permanency, intendment, functionality, and marketability test, towers and prefabricated buildings do not qualify to be immovable property, but are movable property, and hence they are goods. So here also the Supreme Court somewhat relied upon the functionality and the purposive intent or purposive interpretation as to what they are used for and what is the functionality. The towers and prefabricated buildings are not permanently annexed to the land or the building, as the tower can be removed or relocated without causing any damage. The attachment of the tower to the building or land is not for permanent enjoyment of the building or the land. The tower is fixed to the land or building for enhancing the operational efficiency and proper functioning of the antenna, which is fixed on the tower by making it stable and wobble-free. The fact that the tower, if required, can be removed, dismantled in CKD and SKD and sold in the market was also never in dispute. So therefore, without any doubt, towers and prefabricated buildings are used for providing output service and they be considered as an input. And without the use of this, it is inconceivable that the service provider can provide mobile services effectively. So the Supreme Court upheld the Delhi High Court ruling and overruled the Bombay High Court ruling and said that these towers will be considered as inputs, and therefore Senvec credit is available for the towers against your output services, which is telecommunication services. So the impact will obviously, this judgment will significantly improve the telecom industry's financial health. They will be able to, a lot of thousands of crores of blocked credit, because this was their main infrastructure. The towers are something which is the main backbone of any telecom industry. A lot of investment goes into constructing or erecting these towers. So the credit which was stuck till now for these telecom companies that will be freed up. So it will help the telecom companies in their cash flow situation. It will also reduce the overall cost of service delivery across the sector. Um, However, this under the GST regime may not be applicable because the GST law specifically excludes telecommunication tower from the definition of plant and machinery for input tax credit purposes. Now, whether that is going to be challenged after this judgment, um, like the challenge in safari retreats, that is a possibility, and we'll have to see whether these towers applying the ruling in safari retreats can also be called as a plant and machinery by looking at the purposive test. So that is something which we can discuss later on, which is our next case over here, Chief Commissioner of CGST and others versus Safari Retreats. Now, this again is a very hyped sort of issue and judgment. So just to provide a brief background, Safari Retreats is a company which is engaged in constructing shopping malls, and thereafter it used to rent out constructed units to various tenants. There was a lot of accumulated ITC on goods and services which the company had used in construction of these malls, including cement, steel, and other professional services. However, when the company wanted to offset this input tax credit, it was denied the claim by the authorities, citing Section 17, subsection 5D of the CGST Act 2017, which restricts ITC on certain goods and services as well as works contract service when used for any output activity apart from being used for further works and contract services. So the company challenged this provision under Section 17(5)(d) and argued that ITC should not be blocked when immovable property is used for further taxable supplies such as renting or leasing. The Honorable Supreme Court on analysis of the administrative input tax credit as per GST law delivered this judgment, which was highly anticipated and awaited. And it addresses the key issue whether plant and machinery in the explanation appended to Section 17 equally applies to the expression plant or machinery which is used in 17(5)(d), and whether the construction of building necessary for providing a service is a plant qualifying under the exception provided under Section 17(5) subsection D of the CGST Act. So here the Supreme Court held that Section 17(5) subsection D has to be read differently from the words plant and machinery used elsewhere in the CGST Act, and any different interpretation would cause violence to the intention of the legislature when drafting this section of the CGST Act. According to the Supreme Court, it relied on the functionality test. In each case, it said it has to be seen whether what you intend to take credit of is actually a plant and machinery for you or not. So from case to case basis, it might differ as to what exactly is the plant. So today, for example, if that particular premises or a building is constructed and is there for a specialized purpose, then it can qualify as a plant or a machinery. However, in certain cases, it may not be sort of specifically be for a it may not be for a specialized purpose, and therefore, in those cases, it may not qualify as a plant or machinery. So the Supreme Court left the interpretation sort of a little open-ended and said that we'll have to look at it as to what is the purpose of the purpose of use of that particular plant and machinery to determine whether the credit will be available or not available. So, for instance, the Supreme Court stand basically in the past has also been that, let's say for hotels, the building is not a plant and machinery, even though the services which the hotels give out are renting services of accommodation. However, for hotels, that is not a plant. The building is not a plant or cannot be considered as a plant. Similarly, for cinema halls, also the Supreme Court had previously held under income tax law that a cinema hall building is not a plant, even though your main purpose over there is to go and watch a movie, but that cannot be considered as a plant. So the Supreme Court upheld the revenue stance that Section 17(5)(d) blocks ITC for goods and services used in construction of immovable property, even when the property is let out. So that is something which was upheld. The court ruled that this restriction is in line with the legislative intent to prevent misuse of ITC and does not violate constitutional provision. However, it did provide a very nuanced interpretation, suggesting that ITC may be available if the immovable property qualifies as plant. As we were discussing, whether it qualifies as plant or machinery, it all depends upon what purpose that immovable property is being used for. So commercial properties like shopping mall typically do not fall into this category unless they meet the functionality test. So in effect, safari retreats for that company itself, this case was not a very favorable case because they said that for shopping malls, it is not a plant. The building is not a plant. So what is the impact of this? Basically, now you will have to assess if you have to take credit of a building or any kind of services which are in relation to works contract services for goods or services. You will have to see whether the building actually qualifies as a plant and machinery. So you will have to carefully analyze the operation, see what is the purpose and what are the functions of that building, and whether it can qualify as a plant before claiming any ITC under GST law. However, this judgment does provide a window opportunity to real estate, hospitality, malls, co-working space, and other like sectors where the construction can now be assessed in terms of the Supreme Court judgment. And input credit, which was previously held to be unavailable, may be allowed, obviously subject, to a lot of litigation and disputes. And we've seen already that the department has started again, raising certain demands, etc., saying that these are not buildings. So you will have to basically, in that case, satisfy that this will fall under definition of plant. The next case, which we will discuss, again, a very important case, is KP Mozika versus ONGC Corporation Limited. Now, this case is under the VAT regime. And the history is that there was certain transaction of leasing of motor vehicles, cranes and tankers, which were undertaken between KP Mozika and ONGC. And the issue was whether this constitutes a deemed sale, therefore subject to sales tax under Article 366(29)(a) sub-article D, or whether these are services subject to service tax. So it's a typical case of leasing of certain motor vehicles and tankers and cranes. Um, Now, in this case, the appellant, which was KP Mozika, had engaged in contracts and it had provided certain vehicles to ONGC and to Indian Oil Corporation. And there was a demand of VAT on these renting activities because this Assam VAT department had said that these are qualifying as deemed sale because you are transferring the effective ownership, control, and possession of these vehicles, cranes, etc., to ONGC. The appellant had contended that no, that was not the case. The control and possessions were never passed on, and the appellant had provided their own drivers, crews, etc., to operate these cranes or operate these tankers, and therefore there was no effective control or possession which was ever transferred to ONGC by the appellant, and therefore they don't qualify as a deemed sale transaction and should be classified as a service. Now, in this case, the Supreme Court had interpreted clause D of subclause D of clause 29A of Article 366 and referred to the decision in 20th Century Finance Corporation in state of Maharashtra to emphasize that the transfer of right to use goods necessitates exclusive possession by the transferee, a condition which was not satisfied in the contracts between the appellant and ONGC. So when we talk about exclusive possession, it means it has to be to the exclusion of everybody else. So whoever is getting the possession has to have exclusive possession and nobody else can have possession. It also referred to the judgment of Justice Lakshmanan in the case of BSNL, where they had laid down 5 sort of key criteria to determine whether a particular transaction qualifies as deemed sale or whether it will qualify as a service. The court highlighted that the contracts in question did not intend to transfer the right to use specific goods to ONGC. Instead, they aimed to provide services such as use of cranes and tank and trucks. As the control over these assets remained with the contractor, the court held that the contracts did not fall under sales tax or VAT and should be subject to service tax. So this court's decision emphasizes the importance of what the effective control and possession in determining whether the contract constitutes deemed sale or a service agreement. And the main takeaway from here is that you'll have to see whether the control and possession is being transferred on an exclusive basis to the transferee, or there is some part of the control possession which is being retained. One more aspect which needs to be determined in this case is whether the goods which are being transferred uh, um, are those goods identifiable, are those goods specified, or is it something which is not an identified good? For instance, you might today say that I will give you let's say 5 taxis on hire. However, you do not identify which 5 taxis. You just say I will give you 5 taxis. It means that the goods are not identified. You can give them any 5 taxis of any model, any make, any registration number. But when you say that I will give you 5 taxis bearing this registration number, then those goods become identified and specified goods. So that is also an aspect which needs to be considered as per the Supreme Court while determining whether there is a transfer of right to use or whether it's a mere service arrangement. So with that, we come to the end of the presentation. And I'll just take some questions which are on the chat box. Okay, what will be the impact of Supreme Court judgment on levy of GST on royalty? Please explain theory of prospective overruling. So we discussed what is prospective overruling. It is basically when a established or a settled principle of uh, um, of law is sort of overruled by the Supreme Court. And at times what happens is some position has been there for last 20, 30 years and it suddenly gets overruled by the Supreme Court. Then whether that will apply prospectively or retrospectively. That is basically the concept of prospective overruling. And the Supreme Court said that prospective overruling will not work in certain cases, and in case where in the case of Mineral Area Development Authority, the Supreme Court said that the overruling would always be retrospective. So if something has been a judgment has been pronounced by the court, let's say 20 years back, which is overruled, then that judgment has been overruled since the last 20 years only. However, it also held that because of this, the assessee should not be in any way inconvenienced. So therefore, in MADA case at least, Supreme Court said that if the state has to demand tax on royalty, it should not ask for any interest or penalty. Impact of SC judgment on levy of GST on royalty is basically um, something which needs to be seen. But yes, as we discussed, uh, the Supreme Court said that the power to levy tax on land and building, including on mineral rights, is with the state and not with the center. So therefore, technically, under at least the service tax regime, the center did not have power to levy any service tax. It should have been the state who had the power to levy any taxes. Uh, coming to GST, the entries still remain as it is. As you know that there are certain instances like leasehold rights and other even for that matter, even royalty for under GST regime is also under challenge for the Supreme Court. So this judgment will definitely play a role in it. And going by this judgment, yes, the center will in that case may not have the power to levy GST on royalty. Uh, But we'll have to see what the Supreme Court eventually says in this case. But going by MADA, yes, that seems to be the position as of now. Uh, Bharti Airtel versus Commissioner CGST. Would works contract service be covered under the terms goods or services covered in 17.5D instead of 17.5C? See, goods or services again is something which is, goods or services is already defined under the GST Act. What is goods and what is service? And works contract is also sort of something which is, which we know to be a service where both goods and services together are involved. So I think if we have to look at the definition of goods or services, we'll have to look at the definition under the Act itself. And if works contract is not covered within the definition of goods and services, then by virtue of this judgment, we can't say works contract is either goods or service. Used on own account as explained in the judgment, what impact will not have on GST? So, Mozika judgment again under GST, it might not have so much of impact because under GST, as you know, um, both the service tax and VAT has now been merged. So for GST, it is pretty clear that you'll have to charge a GST for right to use. And the only thing is whether it is going to be or what is the rate of that GST, that still remains a question because in some cases it may be 12% or 18%, depending upon what exactly is the nature of the goods which has been given for leasing activities. So under GST, not too much of an impact, but mostly the impact would be for the period before 2017 for services and for deemed supply of goods. Used on own account, basically, as has been explained, is something which you are using for your own purpose, and it is not being used for um, further rendering any services or goods for the supply of services or goods. So when we say used on your own account, specifically from a construction standpoint, as was in the case of Safari Retreats, they were using it for construction of a mall, which was basically being used for renting of units as shops. So those were used on their own account, as opposed to, let's say, if a contractor is using certain goods and services for providing certain construction services, then those goods and services are not being used on their own account by the contractor. They are being used for further supply of goods and services. So that was basically the meaning of used on own account, is when you are using it yourself for your own purpose for construction activity. Let's say for constructing a factory or an office or any kind of hotels, malls, etc. Okay, I think that's it. Thank you so much.